Essay 315. Identifying and assessing the risk of material misstatements through understanding the entity and its environment. Audit risk and its components. Audit risk equals to risk of material misstatements into detection risk. Another formula for calculating audit risk equals to inherent risk into control risk into detection risk. Audit risk components. First one, inherent risk. Assuming no internal controls, chances that transaction balances and disclosures are materially misstated. Control risk. Internal controls are not able to prevent, detect, and correct misstatements. Combination of inherent risk and control risk is risk of material misstatements. Risk of material misstatement is a combined risk inherent into control. Circumstances that transaction, balances, and disclosures presented in financial statements are materially misstated prior to audit. Sampling risk. Chances that conclusion obtained from sampling does not match with population. Non-sampling risk. Chances that conclusion goes wrong because of inappropriate audit procedure. Combination of sampling risk and non-sampling risk is detection risk. Detection risk. Chances that material misstatements are not detected by auditor. Combination of both risk of material misstatements and detection risk is audit risk. Audit risk. Chances that final opinion given by the auditor is inappropriate. Unmodified opinion is given when modification was required. Next, inherent risk. Inherent risk. Risk before considering related controls. Susceptibility of assertions about transactions, balances, disclosures to be materially misstated individually or in aggregate. Examples of higher inherent risk. Business risk, complexity, estimates, factors in entity affecting several transactions, balances, disclosures, assertion. Example, factor affecting going concern. Control risk. Control risk definition. Controls not able to prevent, detect, and correct material misstatements individually or in aggregate in assertion at transactions, balances, disclosures level. Reasons because of ineffective design, implementation, and maintenance. Elimination. Control risk can be reduced but cannot be eliminated because of top level management override of controls, middle level collusion, lower level human error. Next, assessment. Separate or combined, quantitative or non-quantitative. If it is big client, if the internal control system is good, separate assessment in respect of inherent risk and control risk need to be made. That means separate assessment of risk of material misstatements need to be made. In case of small client not having properly documented internal control system, combined assessment can be made in case of risk of material misstatements. That is combination of inherent risk and control risk. Risk of material misstatements. Chances that financial statements are materially misstated presented to the auditor prior to audit. Components of risk of material misstatements, inherent risk, control risk. Next, detection risk. Detection risk, risk that audit procedures are not able to identify material misstatements individually or in aggregate. Detection risk is inversely proportional to risk of material misstatements. Factors affecting detection risk. Effectiveness of audit procedures, planning, assignment of the personnel, professional skepticism, direction, review, and supervision. Detection risk is inversely proportional to risk of material misstatements. Risk of material misstatements not controlled by the auditor depends upon the business and environment. Detection risk is controlled by the auditor depends upon test of controls and substantive audit procedures. Therefore, detection risk is inversely proportional to risk of material misstatements. Auditor's objective is to reduce detection risk to such low level that audit risk comes down to acceptable low level. Next, audit risk. Auditor expressed unmodified opinion where financial statements have been materially misstated, or auditor expressed modified opinion where financial statements are not having material misstatement. It does not refer to auditor's business risk. Audit risk equals to risk of material misstatements into detection risk, or inherent risk into control risk into detection risk. Next, risk assessment procedure. How to collect information to obtain understanding, entity and environment. including internal control system, to identify and assess risk of material misstatements, shall include inquiry, observation, inspection, analytical procedures, understanding of the entity and its environment, what information should be collected, state of economy, nature of industry, regulatory requirement, ownership and governance, financing and structure, type of investments, nature of operations, financial reporting framework, selection and application of accounting policies, financial performance, objectives, strategies, and business risk. These are the information which need to be collected by the auditor from the management. Next, identify and assess risk of material misstatements. This will be assessed at two levels: financial statement level, assertion level. Audit procedure for identifying and assessing risk of material misstatements. First one, identify risks throughout the process of risk assessment procedure, related risks at assertion level, at financial statement level, and likelihood and magnitude of material misstatement. Likelihood means probability. First, financial statement level risk. This is the risk related to financial statements as a whole, affecting many assertions. Not identifiable with specific assertion may increase risk at assertion level. General case of such risks: deficient internal control environment, concern about integrity of the management, risk of management misrepresentation can be such that audit cannot be conducted, concerns about conditions and reliability of entities' records such that it is unlikely to get sufficient and appropriate evidence. It may lead to qualification or disclaimer as per SA 705. Assertions. Assertions are representation or information by management in financial statements. These are examined by auditor for potential misstatements. Assertions are of two types: explicit assertions, implicit assertions. Explicit assertions are directly or clearly stated in financial statements. They can be positive or negative. Implicit means not directly written but generally assumed or understood. Account balances, assets and liabilities. For example, regarding a land and building 100 crores, assertions regarding assets and liabilities are regarding existence, completeness, valuation, rights and obligations. Regarding transactions, that is income, expenses, inflows or outflows, P&L. For example, sales of 1000 crores, the assertions by the management are regarding occurrence, completeness, accuracy, classification, cutoff. Regarding presentation and disclosure in notes to accounts, if lease rent in next 5 years is 20 crores, then assertions regarding this lease rent is regarding occurrence, rights and obligations, completeness, accuracy, valuation, classification, understanding. Important point is high level of inherent risk means significant risk. Controls which affect control effects not considered. That risk is called as significant risk. That means in significant risk, control effects are not considered. In case control effects are considered, then we will get high level of risk of material misstatements. Next, a risk that requires special audit consideration. Determine whether risk is significant risk. Exclude effect of controls. Consider following factors: significant changes, a risk of fraud outside the normal course of business, complexity, subjectivity, related parties, significant transactions. After determining for significant risk, obtain understanding and relevant controls. Documentation. Risk assessment procedure performed, understanding and obtained resources. Obtained and sources. Identified and assumed risk of material misstatements at financial statement level and assertion level. Related controls and discussions concerning engagement team. These all the these all are the items that need to be documented. Risk assessment procedure performed and assumed risk of material misstatements and related controls and discussions need to be documented. Next, definition of internal control system. Internal control system is a process designed, implemented, and maintained by those charged with the governance, management, and other personnel to practice following with reasonable assurance: to practice laws and regulation compliance, safeguarding assets, effectiveness and efficiency of operations, reliability of financial reporting. Points covered for definition, objectives, and general purpose all are same. Components of internal control. There are five components of internal control. First one, control environment. It is the management attitude towards internal controls. Second, risk assessment process. Third, control activities. Fourth, monitoring controls. Fifth, information system internal controls. Information system, information technology. So there are five components of internal control. First one, control environment. What do you mean by control environment? Attitude, importance, awareness, ability, action of those charged with the governance and management concerning internal control system. Elements of control environment. First one, those charged with the governance related attributes and participation of those charged with the governance, experience and stature, independence from the management, extent of involvement and information they receive, appropriate action, ask difficult questions, interaction with internal auditors and external auditors, management related, management philosophy and operating style, approach towards business risk, attitude towards information processing and accounting function, attitude and action towards financial reporting, human resource related, policies and practices, recruitment, orientation, training, evaluation, counseling, promotion, compensation, remedial action, competence related allocation, management consideration of a competence level, their translation to skill and knowledge, organization structure to connect employees and teams to achieve objectives of planning, execution, control and reviews, authority and responsibility, assignment of authority and responsibility, authorization hierarchies and reporting relationships, communication, communication and enforcement of integrity and ethical values, satisfactory control environment. Positive factor affects evaluation of other components of internal control system, reduces risk of material misstatements, affects nature timing extent of a further audit procedure, not absolute deterrent to fraud. Only satisfactory control environment does not deterrent, detect, correct material misstatements. PDC, prevent, detect, correct. Next, entities risk assessment process. Definition: how management identifies business risks relevant to preparation of financial statements, compliance of financial reporting framework, that significance, magnitude, likelihood, probability, action to respond. It includes internal or external events, transactions, circumstances which affects ability to initiate, record, process, report financial data. Next, circumstances leading to risks. Hint is PFA tragic risk assessment. New personnel, P personnel, F foreign operations, expanding foreign operations, A accounting pronouncements, new accounting pronouncements, T technology, new technology, R regulatory or operating environment, changes in regulatory or operating environment, A activities, new business models, products or activities, G rapid growth, rapid growth, I information system, new or revamped information system, C corporate restructuring. So circumstances leading to risks. Hint is PFA tragic. Next, control environment. Control control activities. Third one, control activities. Control activities relevant to audit can be categorized as first one, segregation of duties, assigning different people responsibility, authorizing transactions, recording transactions, maintaining custody of assets to reduce opportunity that serve people perpetrate and conceal errors of fraud. Second one, physical controls, physical security of assets and records, authorization of access to complete program and data, periodic counting and comparison with control records. Next, performance reviews, actual versus prior period budget, forecast, etc. Operating versus financial, internal versus external, analyze and investigate relationships and take corrective actions. Information processing, general IT controls and application controls, meaning and examples. Fourth one, monitoring controls. Monitoring controls definition. It is the process to assess effectiveness of internal control performance and taking remedial action. Auditor's responsibility shall obtain understanding of how entity maintains controls, ways of monitoring, through ongoing activities, separate evaluation, combination of above, may use information from external parties, example customer complaints, regulatory comments, etc. In case of small entries, monitoring accomplishment by monitoring accomplished by management or owner or manager, close involvement in operation to identify significant variation from expectations, inaccurate financial data, performing remedial actions. Next, information system, including the related business process relevant to financial reporting and communication, components of control environment. Information system consists of a physical and hardware component, software, people, data. Many information system makes extensive use of information technologies. Reporting objectives of information system same as assertions. Assertions same as assertions. First one, completeness. They should ensure that all valid transactions are identified and recorded. Accuracy. Ensure that transactions are recorded and measured at proper monetary value. Classification. Ensure that transactions are classified and ensure that sufficient detail is available regarding transaction so that on timely basis they can be classified. Cutoff. Transaction should be recorded in correct accounting period. Presentation and disclosure. Ensure that transactions are properly presented in financial statements and adequate disclosures are given in notes to accounts. Affect quality of information generated from the system directly affects management's ability to make appropriate decision in managing and controlling entity and preparing its financial reports. Role of proper communication. To improve information system, there should be proper communication regarding roles and responsibilities pertaining to information system. It can be in the form of policy manuals, financial reporting manuals. Communication can be made orally, electronically, or through actions of the management. Tools of internal control system review. Narrative records, flowchart, checklist, questionnaire. First one, narrative records. What do you mean by narrative records? These are complete and exhaustive description of internal control system prepared after observation and actual testing, recommended where there is no formal control system. Disadvantage is to comprehend system, to identify weakness, to incorporate changes. Next, flowchart. Flowchart is graphical presentation of internal control system. Disadvantage of flowchart is most concise way of review, minimize amount of narrative explanation, bird's eye view of system, flow of transaction and integration, easy to spot deficiencies and suggest improvements. These are the advantages. So these are the advantages of flowcharts. Most concise way of review, minimize amount of narrative explanation, bird's eye view of system, flow of transaction and integration, easy to spot deficiencies and suggest improvements. Checklist. Checklist definition. Series of instructions or questions which member of staff must follow and answer. He completes instruction and put his initials after performing instructions. Answer to checklist will be yes, no, or not applicable. Example checklist for purchases. There will be tender, a written order, PO standardized, PO pre-numbered, stock control personal person independent of a stock control person independent of a purchase receipt inspection custody evaluation. This checklist will be studied by principal or manager or senior. Internal control questionnaire. Definition. It is the comprehensive series of questions. Questionnaire is usually issued to the client. Client is requested to fill it. Questions framed where answer is yes, no, not applicable, yes, if it is satisfactory with internal control system, no, suggest weakness, not applicable, not relevant. Most widely used one, framed in one complete set or in sections, done annually. If inconsistencies or incongruities noticed, the matter is further discussed. Internal controls in small business. Audit objectives are same. Controls in small and large is not same. Large business are not same. Segregation of duties missing. In same case, compensated by owner supervisor control. Extensive use of substantive procedures. Next, risk because of IT systems. What are the risks because of IT systems? First comes IT personnel. IT personnel gaining access privileges beyond necessary is a risk. Then comes data. Unauthorized access leading to destruction, potential loss of data, non-existence transaction, unauthorized transactions. Next, then processing, manual intervention, inaccurate processing, processing inaccurate data, then changes, failure to make changes, unauthorized changes to system, unauthorized changes to master file. These are the risks because of IT systems. Next, limitation of internal control system. Even if internal control systems are effective, there is only reasonable assurance related to top level management because of judgment by the management, related to mid level management because of collusion among people, because of related to lower level employees because of human judgment and decision making, lack of understanding purpose. These are the limitations of internal control system.